I read this article this weekend in the Wall Street Journal. It says Dow, 1,339,000. That kind of caught my interest. So as you know, today the Dow is hovering around 13,000. But what the article pointed out was, if you went back to the beginning when the Dow was constituted in 1896 and you reinvested your dividends, what would it have grown to? Notice it would have grown to 1,339,000. That's what the index would be at today, or 100 times higher than it is without dividends. Why did I bring this up? Most of the time what you see on the news when they quote the Dow or they quote the S&P 500, that is price only. It doesn't include reinvesting dividends, which is what our investors do. Secondly is they went back and they said, well, what was the real growth, in other words, growth after inflation of $1 invested in 1896 versus today for the Dow. Notice if you reinvested dividends after inflation, the $1 grew to almost 47,000. Now, you're thinking, David, I don't have 116 years. Tell me something more relevant. So I went back and said, let's look at 30-year periods. I looked at starting in 1927 through 2011, and I looked at all those 30-year rolling year periods. The worst performing did 5.9% annualized for the the Fama French U.S. Small Cap Index. That's after inflation. The best, if you invested in the middle of the Great Depression, was 1933. It grew at a 14.5% annualized rate of return after inflation. Most recently, from 1982 to the end of 2011, the annualized return on the small cap index was 8.4 after inflation. Some of you are so used to hearing nominal numbers, you could probably add about 3% inflation into this number, and that brings you up to 11.4. What does that mean in terms of real dollars? It means in 1982, if you invested $1 million, it grew after inflation to about 11.2 million. Tremendous growth by owning equities. So what does that mean? 10 times the real purchasing power capacity by owning small cap stocks over the last 30-year periods. But only if, in this case, I'm going to show you 4 fundamental things you had to do. Number 1 was own equities. You can't do this with fixed income. Number 2 is to tilt towards small and value companies like we do with our investors, because there's higher risk premiums there. Number 3 is stay fully invested the whole time. That one takes a lot of discipline, because when things get bad, people tend to want to flee equities. And last but not least is buy low and sell high. And the way we systematically do that for our investors is to rebalance. Know your investment strategy, harness the entrepreneur thinking and innovation and growth potential of equities. Remember, your financial survival is on the line.